Let's talk about something pretty much every business owner runs into. You sell off an old piece of equipment, maybe a company car, and you think, great, cash in the bank. But what about all those tax deductions you've been claiming on it for years? Does the tax office just forget? Well, not quite, and that's exactly what we're going to break down today, balancing adjustments.
So picture this. The company van is gone. You got a decent price for it. For the last few years, you've been getting those nice tax breaks for its wear and tear, right? But now that it's sold, how does the tax system square everything up? It has to account for the cash you just got versus the deductions you already took. And this is where the tax system does this really smart thing called a balancing adjustment. The name says it all, really. The whole point is to perform a balancing act, to make sure that at the end of the day, the total tax relief you got for that asset perfectly matches what it actually cost your business while you owned it. It's all about fairness.
Probably the easiest way to wrap your head around this is to imagine one of those old-school balancing scales. On one side of the scale, you put the cash you got from selling the asset, and on the other side, you put what the tax office thinks that asset is worth, to them after all the deductions you've claimed. Our job is to see which way that scale tips.
Okay, let's nail down a couple of key terms. That value for tax purposes has an official name. It's called residual expenditure, or just RE for short. All it is the asset's original price minus all the capital allowances, the tax deductions you've claimed. It's basically the asset's leftover value in the eyes of the taxman.
Now, the other side of our scale is way simpler. It's the disposal proceeds. That's just the money you got when you sold the thing. So, to recap, we're just comparing the asset's leftover tax value, the RE, with the actual cash you got in your pocket, the disposal proceeds. So what happens if the scale tips your way? Let's start with the good news, shall we? This is when you get something called a balancing allowance. You get a balancing allowance when the price you sold that asset for is less than its remaining tax value, the RE. What that really means is, over the years, you didn't quite get all the tax relief you were entitled to. The asset lost value faster than your deductions kept up.
And here's why it's good news. A balancing allowance is an extra tax deduction you get to claim in the year you sell. It's the tax system's way of saying, oops, our bad, here's the rest of your deduction. And the formula? Super simple. It's just the RDE minus what you sold it for.
Let's put some numbers to it. Say your asset's tax value, the RE, was 50,000 ringgit, but you could only sell it for 40,000. Well, the difference there is 10,000 ringgit. That 10,000 becomes your balancing allowance. You get to deduct it straight from your taxable income for the year. That's a fantastic outcome.
But a scale can tip two ways. And this brings us to the other side of the coin, which is known as a balancing charge.
A balancing charge happens when you sell the asset for more than its remaining tax value. So in this case, the tax system looks at it and says, hold on, you actually claimed a little too much in deductions over the years because you got a great price for it in the end.
You can think of a balancing charge as kind of like a tax clawback. It's an amount that gets added back to your taxable income. It's just truing up the numbers to correct for those extra deductions you got. The formula, as you might guess, is just the reverse of before. Sale price minus the residual expenditure.
So let's use our same asset with that 50,000 ringgit tax value. But this time, you had a great day and sold it for 60,000. Well, that's 10,000 more than its tax value. That 10,000 ringgit is your balancing charge, and it gets added to your income, which means, you'll pay a bit more tax that year.
Okay, so now we get the what and the why, but how do you actually figure this out for your own assets? Let's just walk through a really simple step-by-step guide.
It's really just a straightforward four-step process. First, you pinpoint the exact asset you sold. Easy enough. Second, you calculate its RE. Remember, that's the original cost minus all the deductions you've ever claimed on it. Third, you compare that RE number to your sale price. And finally, based on which one is bigger, you just plug the numbers into the right formula to get your balancing allowance or balancing charge.
And this table here really lays it all out perfectly. Look, in both scenarios, the starting point, the residual expenditure, is exactly the same, 50,000 ringgit. But see how everything changes based on the sale price? Sell for less, you get a tax deduction. Sell for more, you get a taxable addition. It all hinges on that final disposal price.
So let's bring it all home. Why is understanding this so critical for anyone running a business? Let's just quickly recap the most important things to remember. Okay, so here are the big takeaways. First, this whole system is just about tax fairness, nothing more.
Second, it applies to most of your big-ticket business assets, machinery, vehicles, even buildings. Third, and this one is so important, you have to have good records. Without them, this is impossible. And last, remember this is a one-and-done adjustment. It only happens in the year you actually sell the asset.
And that really brings us to the final thought I want to leave you with. This isn't just some boring tax theory, right? It's a practical part of managing your business's finances properly. So the real question is, are your asset records in good enough shape to handle the balancing act when it's your turn? Definitely something to think about.